What you are looking at is not just a chart. It's the blueprint for a high-probability trade, a masterclass in reading market sentiment. The entire story begins at a critical resistance level, a price ceiling where history tells us sellers have consistently overwhelmed buyers. The price rallies into this wall and the moment of truth arrives. We don't need to guess what happens next because the market gives us a crystal-clear signal, the rejection candle. This specific candlestick, known as a cock shooting star l'élan with its long upper wick, tells a vivid story of failure. The bulls made their push, but they were decisively beaten back. This is the undeniable proof that the bears are stepping in and defending their territory. The consequence of this rejection is our opportunity, our meilleur trade entry. The strategy is precise and disciplined. We enter short once price breaks below the low of that rejection candle, confirming the bearish momentum is taking control and triggering the move we anticipated. This is the anatomy of a great trade, waiting for the battle at a key level, identifying the winner from the candle story, and then executing with precision to capture the ensuing move. Mastering a breakout isn't just about identifying the moment price pushes through resistance. It's about executing a complete trade plan with precision. And that's exactly what this chart demystifies. The foundation of this plan, and the first thing you must define, is your stop loss. The rule is clear and non-negotiable. Your SL goes above the last high before the breakout. This level is your line in the sand. If price reclaims it, your thesis is invalidated, and you exit with a small, controlled loss. With your risk defined, the chart then outlines a strategic hierarchy for entry, catering to every trading style. For the aggressive trader, entry comes immediately as the breakout occurs, aiming to capture the entire move. The more typical approach waits for a confirming candle to close beyond the level, adding a layer of validation. But for the conservative trader, the most patient and often highest probability entry comes after a retest of the breakout level, where old resistance becomes new support, offering a superior risk-to-reward setup. Finally, your profit-taking is guided by a disciplined benchmark, a minimum 1.2 risk-to-reward ratio. This ensures that your winning trades are, at the very least, twice the size of your potential losses, creating a sustainable mathematical edge that builds your account over the long run. This chart presents a powerful entry idea built on the confluence of multiple technical factors, all signaling a potential major shift in momentum. The core thesis is that price is on the verge of breaking a key zone that would change the market. Structure: moving from a period of consolidation or downtrend into a new bullish phase. The trade is anchored by a significant support resistance SR zone, which is further emphasized by a major institutional level labeled the Bank of Italy. The final trigger for entry is a bullish engulfing candle, a strong reversal pattern. That shows the buyers have completely overwhelmed the sellers, acting as the last confirmation needed to enter. This signal is given even more weight by the presence of several confirming elements: a wick rejection from a dynamic trend line and a successful retest of the SR zone. When price respects the trend line, bounces from the SR level, and then prints a strong bullish engulfing candle, it creates a high-probability sweet spot for a long entry, with the ultimate target being a significant move to the take price as the new bullish structure is confirmed. This chart encapsulates the single most important principle in all of trading: always trade with the trend. While it seems simple, this is the core philosophy that separates consistently profitable traders from the rest. The chart visually demonstrates a clear descending market structure, a series of lower highs and lower lows, where the path of least resistance is undeniably down. In this environment, the chart instructs us to look for sell opportunities, as counter-trend buy attempts are akin to trying to catch a falling knife, fighting overwhelming momentum. The same rule applies in reverse for an uptrend. By aligning your trades in the direction of the established trend, you are essentially trading with the market's momentum, dramatically increasing your chances of a successful trade because you are not guessing where the market will go next. You are simply following the path it has already clearly laid out. This chart reveals a crucial, often overlooked secret of professional traders. Timing your activity to the market's internal clock is just as important as your strategy. It highlights that the best time to trade is during the peak liquidity and volatility of the major trading sessions. Specifically, it points to the opens of the London and New York sessions as prime moments for high-probability setups. The chart consistently identifies these windows as ideal for sell opportunity off the high, suggesting a strategic bias to look for short entries as price tests, and gets rejected from significant highs at the very start of these major market hours. This isn't random. It's when the world's largest banks and institutions are most active, creating decisive moves and clear rejection patterns at key technical levels, like the noted Bank of Italy. By focusing your efforts during these specific times, you are aligning your trades with the periods of maximum market momentum and institutional participation, giving your setups a powerful contextual edge. The critical question of where to enter the trade is answered not by a single signal, but by the powerful convergence of multiple technical factors known as a confluence. This chart is a perfect example of how to build a high-confidence entry. The decision to go long isn't based on a hope. It's based on a cluster of bullish confirmations aligning at a precise point. We see a breakout above a key resistance line, which is then successfully retested as new support, confirming the level's strength. This retest is validated by distinct bullish candlestick patterns like a bullish engulfing candle and a morning star formation. Furthermore, this entire setup occurs in alignment with an ascending trend line and finds an additional layer of precision at a significant 61.8% Fibonacci retracement level. When a resistance breakout, a trend line, a Fibonacci level, a retest, and multiple bullish candlesticks all tell the same story at the same time, you have found your entry. A low-risk, high-probability opportunity where the weight of the technical evidence is overwhelmingly on your side. This chart masterfully illustrates the strategic power of patience by answering a crucial question. After a breakout, where is the optimal entry? The answer is to enter on the retest. The sequence begins with an initial up move that often results in a fake-out, a false breakout that traps over-eager bulls before the price snaps back. The true high-probability opportunity emerges during the break and retest phase. Here, the price breaks through a key level, pulls back, and then retests that same level, which has now flipped from resistance into support. This successful retest, often marked by a clear wick rejection, showing that sellers were firmly rejected at the new support level, completes a higher low formation, the very foundation of a new bullish trend. By waiting for this retest, you avoid the initial fake-out and enter the trade with confirmed strength, significantly de-risking your position and aligning yourself with the newly established market structure. This chart introduces a critical filter for every trader's toolkit, the power of double confirmation. It teaches us not to act on the first sign of a reversal, but to wait for a second, validating signal that confirms the market's true intention. The sequence begins with price approaching a key resistance level. The first sign of weakness may appear, but the decisive trigger is a clear bearish reversal pattern, like the evening star candlestick formation, printing directly at that resistance. This creates the first confirmation. The double confirmation comes when this bearish signal is followed by an immediate and decisive break of a nearby support level, completing the formation of a larger lower high and confirming that the sellers are now in full control. This breakdown through support is the green light for your entry, as it validates that the reversal is not just a minor pullback, but the start of a significant new downward price movement, allowing you to short with a much higher degree of confidence.